Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's been writing paid newsletters since the 1980s. He writes paid newsletters with Elliott Gue over Capitalist Times. They have the Energy and Income Advisor, oil and natural gas newsletter with oil production companies, oil and natural gas production companies, master limited partnerships, the pipeline companies. He also separately writes a utility investment newsletter covering electrical utility companies, which is very interesting given the topic with all the energy and infrastructure needed for artificial intelligence and these data centers that big technology companies like Amazon, Google, Meta, Microsoft are all planning. They've announced just absolutely insane capital expenditure budgets for 2025. Roger Conrad, thank you for joining me again.
Thank you for having me.
Now, Roger, we're recording this interview on Tuesday, February 18th, 2025. I started tallying up the projected capital expenditure budgets for Amazon, Microsoft, Meta, Google. Absolutely insane for 2025. It's at least $300 billion. Where do you think this money is going to be invested in? It's not just going to go into software for artificial intelligence, is it?
Well, I mean, a chunk of it will, a chunk of it has to go for the, different processors and so forth, of course, DeepSeek wasn't, in China has come up with a system that apparently uses less power. But what we're seeing is, a lot of investment in some pretty powerful processors. And that requires a lot of energy. So there's a lot of different aspects to this. I mean, there's the construction of the data centers themselves. There's the equipment that's needed, hardware and software. There are connections to the data centers, fiber connections and so on. There are, of course, electricity and the energy needed to generate that electricity. So it's a tremendous investment that's being made in a lot of different areas. And as you know, I kind of look at what I would call the picks and shovels of it, which are, if you go back to that California gold rush metaphor, who were the people selling the picks and shovels? The shopkeepers, as opposed to the people who were actually there, locating gold and so on. And the picks and shovels tend to be a little bit more of a business, a little more reliable of a business in terms of generating cash flow, revenue, cash flow. And for a lot of these companies that are doing this job, because it's huge, they're big and established, and so they pay some pretty nice dividends as well. So that's kind of the corner of the universe here of this massive endeavor, I would call it. And huge spending, as you pointed out, and there's definitely a parallel in other industries to what the big tech industry is doing.
To add to your analogy there with the picks and shovels, these companies, so whether it's Grok, just revealing today Grok 3 with from XAI, Elon Musk's company that does artificial intelligence software, it seems like every month, Roger, or every month or two, a new artificial intelligence learning language model is coming out and progressing and is the new leader. So whether that's DeepSeek, that's like, oh, we're using less electricity, and then that scared a bunch of people. But now the industry has already adapted to that. You have like the other artificial intelligence software companies that have adapted and added what they thought was good, because DeepSeek is open source, and you had a bunch of really smart people in Silicon Valley take a look at the technology and add it to upgrades of additional models. And so if the prices of these software is falling, do you think more businesses are going to start adapting and adding in other industries, adding the software in instead? So the use case, as the prices of this software falls, more people will use it, and that will create even more electricity demand going forward?
Yeah, I think so. I mean, I think, if you want to look back at, a historical parallel that I've in the utility industry, for example, or regarding electricity, back in the early days of electricity, it was pretty much a product only for the very wealthy. And it took Edison's business manager, Samuel Insull. He's actually the monopoly man. So he's the guy on the Monopoly game, the inspiration for that. But he saw the idea of, of just basically mass generating electricity and bringing the price down, and therefore making it really ubiquitous. And that's what's happened. Obviously, we're now using a lot more. So I think, bringing the cost down of basically AI applications that an ordinary business or particularly a business, but an ordinary consumer. I mean, I think we're going to see this technology really adapted in all areas. I mean, the price has been a potential hurdle. Maybe the energy usage is a hurdle for developers and deployers and so on. But I think those problems will be hurdled, and I think we're going to, there's a you see a lot of people talking about, Elliot Gu, who I work with, has used this as an analogy, Jevons paradox, where you bring the cost down of something, but actually the expenditure on that particular item or product goes up. I mean, that definitely happened with electricity as it became more and more used around, and I think we'll see the same thing happen with Chat GPT, not Chat GPT, but various types of functions. And we've only just seen, I guess, AI help people write papers or those types of things. But there's so many other applications that I think can be used, and people can use it to like leverage their business. I think a lot of people have thought in terms of this technology as being something that would take their job away or make them redundant. I really think it's more akin to the use of, say, robots in electricity system management and so on, where you have like a AI some or robot, some basically enhancing what the human team can do. I think that's going to probably be more the adapted model, and there are
You
just so
you mean
many.
like do you mean like auto manufacturing? So like how like when the robots were doing a lot of the heavy lifting and some of the manufacturing, there were still humans involved, but the robots made it more precise.
Yeah, that type of thing, I think, is there, and particularly also, I mean, and also in some of these other industries, and I mentioned, electricity and energy. These are industries that create a massive amounts of data, performance data, because they have all these assets, right? And so, for instance, how much energy is leaking out of a particular pipe, how efficient is a particular electricity grid, and how fast can a grid be shut off or in response to a wildfire. I mean, these are things that AI can tremendously help with by because all this data is being collected. There's the sensors are being deployed almost everywhere. There's drones and so on. There's all this data coming back, but it really, I think that is one thing that AI can do extremely well, is process all that much faster. So I think there's just there are applications probably in every business where someone can use it to um, do whatever they do faster and more efficiently. And again, it's a pretty exciting time to live in. I mean, the hard part of when it comes to investing is when you have so many people competing uh, to develop the best AI, right? I mean, there's and
It,
yet, like you said, I mean,
No
there's like
moat. Yeah,
something.
no moat. No guaranteed profit margin for all these software companies that are innovating. So the leaders are seem to be changing every month or two. But like you said a couple minutes ago, it looks like the software is going to benefit businesses in other industries as they become more productive. Maybe they ask humans to be more efficient. So there's going to be potentially additional innovations in other industries from this software with like energy and healthcare and things like that. So the companies that are developing the software, the artificial intelligence software, they may not be the main beneficiaries.
Yeah, I mean, that often happens, right? I mean, they're definitely driving the innovation here, and with all the spending, I mean, there's a pot of they see a pot of gold at the end of the rainbow there, but it's it's also like, I think, very much a open question as to I mean, who's going to benefit the most? Who's going to dominate the space? It may not be any one player dominating the space. Even it may not come out like some of the other things in what we call technology, uh,
Well,
where yeah, Microsoft has dominated various types of software for office software forever, right? It may not come out like that, but yeah, I mean that's so. That's what's sort of a kind of a paradox of itself, I guess, is so much money has been going into these like large technology companies, uh, and almost kind of scattershot because that's the way a lot of people invest these days, right? You buy an ETF that's just supposedly holds everything in a particular sector, so you've got winners and losers there. And that seems to have worked fairly well so far. But I think, going forward, considering like how much momentum we've had behind these stocks, uh, it looks like it just gets harder and harder to see significant advances, even though, they're driving the change, and the uh, and the dollars and the investment dollars. And they can, let's face it, they can afford it. I mean, these are the wealthiest companies in the history of humankind. So, um,
well, they also have profits in other businesses where they can
yeah,
subsidize building out the data centers and investing in upgrading the software for these learning language models or artificial intelligence agents. So, like Meta owns Facebook and Instagram. I mean, Meta's making tons of profits from Instagram ads. So they can take the profits from their Instagram ads and build out these data centers and invest in an open source platform that Llama. And Amazon has their cloud computing business. Microsoft has their office business, like you said, Microsoft Office. They have their cloud computing business. They could take their profits from these other businesses and then use that to fund additional growth in these other industries in artificial intelligence and data centers. And I think that's what we're seeing.
yeah, I think we'll probably see that for a while,
Now,
as long as this. Yeah.
now, since Roger, we're doing an investing podcast, and your specialty is electrical utility companies and also oil and natural gas. How are the electrical utility companies preparing to handle the construction of all these data centers?
Well, what we've seen, this is, of course, the time of year where companies will issue their full year guidance for, for not only for 2025, but in utilities case, they typically issue guidance for the next 5 years. And that's because, it takes a while to build stuff. And, so you've got to plan it out. You've also got to get regulatory approval and so on. So, they tend to they send out they put together these kind of longer term spending plans that you may not find in other industries, but the main point of this, or one of the big takeaway from this season where they've updated what they did last year is just phenomenal increases, and these are in many cases budgets that were already in the tens of billions. And now, again, some of them are increasing 15, 20, 30, 40%. Uh, the 5 year spending from, so 25 through 29 spending. And that's the magnitude of the increases we've seen from the plans for 2024 to 2028. They're just accelerating everything across the board. It's happening in real time. They are seeing demand from some other sources as well. Data centers are the big one, and some of the estimates now, for 400 terawatt hours new data center demand by 2035, pretty phenomenal. But there's also a reshoring trend of manufacturing. So I think that's kind of the nice thing about betting on the utilities is that there are other drivers of this electricity demand. So if this data center thing, uh, I don't think it's going to come to naught. But let's say it's not as aggressive in terms of new demand as some of the estimates, and that would not be the first time that happened. But let's say it's not. You've still got some pretty um, pretty major electricity consumption uh, forecast increases here. And one of them that I'm just looking at now, it's forecasting to basically double overall demand by 2050. So 25 years, but it's a huge system that we have, and that's a just a lot of new generating capacity is going to have to be constructed uh, one way or another. And again, even if that forecast is cut in half, you've still got pretty phenomenal demand growth, particularly compared to the last 20 years or so, which has been it's been pretty flat. A lot of industry has been overseas. The global supply chains and everything. A lot of we haven't really had electric vehicles and in any kind of other than golf carts. And building electrification wasn't a big thing. Industrial electrification. I mean, so there are a lot of things happening right now that are driving this, and data centers are the big one. And but I think the most important thing here is that this demand is happening in real time. And when I say that, I mean we're not just talking about companies saying, well, in 5 years we're going to ramp it up. Technology companies that need the data centers aren't saying, yeah, this is our plan. 10 years from now, they're saying we want to do this now, and we need supply now. So
And to add to your
again,
points there, I think Meta just paid for 20 data centers and they're running an open source platform. So they're not planning on making a profit building out these data centers and their open source artificial intelligence software initially. You have just, I know you've tracked this as well. I've just seen announcements from data center companies, what in Texas, Florida, Wisconsin, I mean, Georgia, pretty much many different states now where they're announcing a
mhm.
very large data center, not just Northern Virginia, which is the data center capital of the United States.
Yeah, no, that's right. And also Northern Virginia is uh, pretty much ramping everything up as well. So that was clear in the uh, earnings call that for Dominion Energy, which is the utility for Northern Virginia. Um, and that's another company that's really ramping up spending now. I think their 5-year budget is something around on the order of 50 billion. So um,
Is
again,
that way higher than normal, the 50 billion cap? So that's like growth
yeah,
capital expenditure.
yeah, that's yeah, and um, I, it's a considerable amount more than what they had before. They're and again, they're not the only one. I do think you're right when you say Texas is a very big state for this. I mean, their utility out there, Sempra Energy, they haven't reported results yet, but they were talking um, last year about an increase as much as 50% in the spending they were going to do in Texas.
And that
So
was before the Stargate AI project was announced with
yeah, so
OpenAI and Larry Ellison from Oracle. So that was before that announcement.
could literally be yeah. It's pretty amazing story with just what these companies are doing.
So let me ask you then about
Yeah.
Dominion. How is Dominion going to get the energy supply? Are they going to have to negotiate with like EQT, the natural gas producer, to build the pipeline down to the gas turbine center areas? How do they source the power supply to generate the electricity?
Well, the main gas company that has the main pipeline system that comes into that area is Columbia Gas, which is owned by TC Energy. So that's another. Um, there's a lot in the works there regarding maybe trying to get more, at least increase the uh, ability of these pipelines. Increase um, the throughput capacity. And in terms of building a whole new pipeline here, I mean it's too bad they didn't build the Atlantic Coast pipeline. That was a big Dominion energy pivot, I guess, back in the previous decade. And the reason they did it is just basically they canceled this project. It was also owned by Duke Energy. Um, they canceled this pipeline that was going to bring Appalachian gas into Virginia and the Carolinas. Now, Mountain Valley did get built finally after billions of, basically, long delays and billions of overruns because of that. But they went, Dominion and Duke canceled that pipeline, and they could certainly use it now. There is the ability to, there is the possibility of, bringing in LNG, but I think, it's just so much more expensive to do that than to bring it over pipelines. So
Well, we have
that's
the
a really
cheap
good
natural.
question.
It
Yeah,
doesn't make a bunch of sense to bring in liquefied natural gas because we have the cheap natural gas, what in the Marcellus and Utica Shale right there in Pennsylvania and West Virginia. It would make more sense to
right.
just build a pipeline down in Northern Virginia. It's one state over.
It would. It's just a couple hours drive, I think, or a few hours drive, to get to all this like fantastic gas reserves. Um, I mean, it's a very good question. I think a lot of states are probably going to have to rethink where they're, where they stand on gas pipelines and so on. Although a lot of the problem with getting pipelines built, like for example in New England, where a couple of big projects were canceled. Kinder Morgan had one, Williams Companies had one in the previous decade. Again, it was because of this. It was because of the states, and the states basically wanted a deal for their utilities that was going to, they wouldn't let the local utilities contract with, with the pipeline to buy gas in advance, or to make a guarantee to that pipeline that they were going to be buying, gas through that pipeline, and that's a prerequisite for anybody to build anything. I mean, you're going to have to, even if you look at what gets built in Texas these days, a state that's certainly very pro gas, and is willing to approve pipelines and so on. The main hang up, the main hurdle is just getting it pre-contracted. They're just not going to build in. No one's going to build anything and expect for business to flow. So it
And you
you
have
know
the lawsuits too from the EPA, environmentalist lawyers, environmental groups. And not only do you have
yeah,
like the lack of a long-term contract, like you said, at a reasonable price, so it covers like some of the, you have cash flow, so you can go and build out the pipeline. You also have tons of lawsuits from the people that are just anti-fossil fuels.
absolutely. The Atlantic Coast Pipeline actually had federal approval. It went to the Supreme Court, and with the lawsuit that had been filed against it, was defeated there. But within a week of that, they canceled the project. I mean, it
Right.
was just basically, it didn't make sense for them to commit several $billion more, even though they did have all these permits in mind. But there was a basically a gauntlet to run even after that. So um, that's probably a pretty good case for why a lot more data centers get built in Texas, at least, and because of the fact that you can, run gas to these facilities much more quickly. I think, in the Northeast, it's going to be, for Dominion, they're really counting on a whole bunch of different things. They've been extending the life the uh, licenses for the nuclear facilities they have, which are big generator in Virginia. There's only a certain amount of power that can come from those, but they're ways that you can upgrade turbines and various plant components so you can squeeze more generation out of them. And I think that's on their agenda. They're very much looking at things like, with the states backing, the current government's backing, looking at things, like those, like small modular reactors. I mean, the problem is there's just no model for them. There's no, Dominion can't just go in and say, hey, tell a regulator, hey, here's what it's going to cost. So
Oh,
can
so
you
you're
prove
saying they
this?
have to do like a pilot stage program first, and that could take years. So they have to go through this
Yeah,
really time consuming process that's also expensive and prove it up to scale it up then.
I think that's really the nuclear industry's challenge right now is to, there are plants that have been built in this country. They're running pretty well. They're large ones, AP 1000s that are in Georgia that Southern Company has. But they're proving their case. They are, there's still people that are opposed to them and want the company to pay, but um, that's a kind of a big hurdle for nuclear plants. I do know that in South Carolina, the there the co-op there that was pretty instrumental in canceling the project that SCANA was the utility building. They now seem to be interested in coming back to it. Dominion, though, I think is going to require a lot more guarantees. In fact, during the earnings call, the CEO said, "No, we're not interested in doing anything there." I mean, I think there's a site there, there's a project, there's things that are in place. So I think if you gave the right guarantees, but I mean, the states are going to have trouble doing that until there is like some sort of until somebody can go in and say, yeah, this is going to be expensive. It's going to take a long time, but we do have pretty good assurance on this is what the cost is going to be. So if you approve it, it's not going to turn around like, Southern's project, which, something like twice wound up costing like twice what was the initial estimate. And it wasn't Southern's fault. It was, we had more inflation, interest rates got crazy, but also the lead contractor, Toshiba Westinghouse, went bankrupt, so they couldn't fulfill the contract. So Southern had to take it over and eat a lot of the costs. So there's a pretty high, I think, a pretty high burden for nuclear, other than things like reopening closed power plants. So there haven't been a whole lot of new announcements of that lately, but there are definitely some projects that are going ahead. One's at 3 Mile Island involving Constellation Energy, which is the largest nuclear generator in the U.S. by they operate about roughly like half the nuclear power plants um, in the U.S. So if anybody's going to do it, it'll be them. They're working on that. NextEra Energy, which is also a big nuclear company, more known for being the largest, wind and solar uh, and storage company, but they also have a nuclear facility in Iowa um, that is now working on getting a contract with a data center. And if they can do that, then they can reopen that thing. And they've actually made a pretty good case for how that would not be that difficult in terms of the technology needed and just the basic task. Um, Installing a base, pretty standard equipment that they would be using on natural gas, which they're also one of the largest natural gas um, electricity generators in the country. So it's all those things are well in their wheelhouse, but they're not going to do it unless there's a contract, to get that done. So um, it's really interesting. I think it's sort of an all of the above situation where companies are just going to generation companies that need generation are just going to have to try to turn to as many sources as they can. Um, in this in this battle, solar is kind of advantaged because it doesn't take a lot of time to put up. So they, as opposed to what I'm hearing about some of the gas-fired facilities taking 5 years or more and actually costing because of various crunches and labor and the basic EPC, engineering, procurement, construction companies, uh, being in such heavy demand. It's just like when if you're trying to put an addition on your house when everybody else on your street is, you're going to have a hard time contracting it. So, um, yeah, what I'm hearing from a lot of the companies is that it's in some parts of the country, it's going to cost twice as much to build, new gas-fired capacity um, as it would just 2 or 3 years ago. So again, they're just going to have to see what they can build, how fast they can build it, how they can get it supplied. and get it get it going as fast as possible. Um, there are other things we could talk about too. I mean, the stakes are pretty high, I think, for these companies to get that done. I mean, if they are able to, you know, if it's say Dominion is able to meet all the demand that it's seeing in its service territory, particularly from data centers, it's going to grow a lot faster. It's going to grow earnings a lot faster than the 5 to 7% they're guiding to through 2029. But if they, should, and I think one reason they've kept that growth rate where it is, despite ramping up capital spending, is that there are challenges. I mean, they've got to raise the capital. They've got to find ways to build the gas because you're not going to run the system purely on solar, and you're going to have to look at things like nuclear longer term, because as we know, gas prices are volatile, and the price of gas generation can change in a big hurry. That's why companies have a diversified power stack, because they're pretty much problems with every energy source, and only by having a balance can you ensure that everybody's lights stay on. And if there are incidents in the future where demand from data centers is perceived as causing outages, that would be the worst case. But also, causing people's electricity rates to go up inordinately, which that is possibly happening in some places. You're going to see pushback on the consumer side. So I guess that's the bad, or the bear case, for the picks and shovels, is if there's just you know they're unable to produce those picks and shovels at a at a fair enough cost. But I think there are a lot of things to be hopeful about. Certainly there's a lot of money flowing into these areas right now, and I can't think of that's pretty much a pretty good indication. If all that investment comes in, it's not all going to be profitable, but um, it is the surest way for there to be advancement and have these things built. So I don't know if I rambled a little bit there, but that's I think that's the other side of it.
Well, thank you, Roger, for laying out the positives and negatives, pros and cons there of the electrical parts, excuse me, of the different energy components. I mean, I think solar has a place in this with the data centers because it's not baseload electricity for solar, but they can put solar panels either around the data center or on top of the roof, so that could supplement the additional power. But I mean, really, once these data centers are built for artificial intelligence, you have to have them reliable, generating reliable electricity with either natural gas or nuclear, don't you think?
I think you're going to need a good chunk of it anyway. I mean, dispatchable electricity. You do hear a lot of debate on this, of course, and some people maintain, well, you know, battery storage is getting better and better, and so therefore, you'll be able to match it with solar and do a lot of what you need to do. Um, I think that for a lot of companies would be an ideal scenario, but I don't think the technology um, is there. So I do think that's why you see the interest in restarting some of these nuclear plants,
Well,
particularly going into
big
yeah,
tech is funding those, right? So big tech is paying, I
yeah,
think, 80% above the spot price to get the nuclear power. So you have like Amazon and Meta and Microsoft and Google. They are like, okay, we want net zero, we want carbon free power. Yes, we will invest in some solar, but they want more reliability than just solar, which is why they're negotiating, like you said, with the electrical utility companies for guaranteed nuclear power.
yeah, and companies like Constellation. This is an opportunity for them. I did some research in terms of nuclear plants that have been shut over the last since the Fukushima accident. So that a lot of plants were shut since then, a lot of them were shut because of low natural gas prices from shale, which we'll talk about in a sec. But they were shut down, and now suddenly there's more interest. So there's about a dozen plants. Constellation has a number of them. NextEra Energy, and there's some other providers as well. So it's interesting. There are also the plants that are currently operating. That's been a little problematic signing them on to contracts that because of the grid operator says, well, this is power that's been going into the general grid, and now you're taking it out, and just giving it to one particular player. So there's been some pushback on that, but again, I think that's an area where I think there's a lot of interest. That said, what's available now is also a very huge question, and while you can put solar in 12 to 18 months, big facilities, you can pair it with battery storage at the same time, and you can do that. Um, it's only going to go, it's only going so far. And so that's really the interest in natural gas because, the technology is available. These aren't, gas fired projects, as we were saying. I mean, you can't just go out and just build a plant and expect to run it on gas unless you have one. You got to have pipelines bringing you supply there. You've also got to have permitting, and we were talking about some of the court challenges as well. I mean, it remains to be seen like how severe some of that opposition is. But I would bet it's not any dimmed in many parts of the country. So
Well, there should be
yeah,
less red tape for at least the next couple of years, right? With Trump in the White
yeah.
House, a shale drilling Secretary of Energy now, and then the Republicans have a slight majority in Congress. So that should at least give a couple year window to where some of these liquefied natural gas export facilities and some of these pipelines.
Yeah,
Um,
I think there are things that they can do. Obviously the export facilities. I think that's something that they can speed along pretty fast. But I would also just I mean it's also true that during the Obama administration, basically every pipeline that was proposed was built, except for Keystone XL. That was kind of a fig leaf, but they basically approved everything. During the Trump administration, you definitely had willing people, in these, in the FERC and in these various commissions, to get pipelines built. But pipeline construction just ground to a halt, and a lot of projects were canceled. And again, it wasn't anything to do with. Obviously, it wasn't anything to do with what the administration was doing or the federal side of regulation. It was like courts and so forth. So this is an area where I think we have to be pretty careful. I know there was a rumor going around about a New England, New York gas pipeline. Well, maybe, but that there's a reason why those didn't go through in the previous decade.
so
And that's
federal might so to add to your points there, the
yeah.
federal with Trump and a slight Republican controlled Congress then would help at the federal level, but then you're saying the states and the environmentalist lawyers would still block it.
They would certainly put up a lot of roadblocks to getting it done, even with the Feds saying, "Yeah, go ahead, build whatever you want." I mean, and again, that's a problem for new gas in a lot of parts of the country, but it's not a problem in others. And I think the larger point here, at least in terms of investing, is that there's a tremendous opportunity for gas, for pipelines, for producers, for generation in parts of the country that are definitely more friendly to gas than, say, the New England states. Texas is probably the best example, but there are also other areas too, parts of the country along the Gulf Coast in the southeast. In parts in the Southwest, even in the Midwest and the Rocky Mountain states. So these are all areas where you can go and build a gas pipeline. You're very likely going to have some opposition. NIMBY runs pretty hard in many parts of the country, but you have a much better chance of getting things built. So that's why I think, again, that's what's interesting to me about the data centers coming in, being built in parts of Texas. And so you have a major pipeline companies like Energy Transfer Partners signing on, companies like Cloudburst that have a big, that plan major uh, facilities in Texas. Energy Transfer has infrastructure in Texas already, and they are building more bringing gas from different parts of Texas, particularly the Permian Basin, which has very cheap gas. It's primarily what's called associated gas, so which is produced along with oil from shale. So these companies want to produce a lot of oil, and gas is part of what's coming out. In many cases, that's been flared in the past, but now you see companies like Energy Transfer coming in, building the gathering systems and pipelines and so forth, and turning it into useful uh, product. And of course, it's very useful for Cloudburst and other, which is building around San Marcos, Texas. Um, and they're expecting something on the order of 1.2 gigawatts uh, um, worth of supply. That's what they've contracted with power supply or gas supply that could power 1.2 gigawatts of power production. That's what the Energy Transfer contract. They're not the only company that's getting things done here and finding, suddenly, new contracts. The business of midstream really over the last decade has been they're almost running in place, and the larger players have been growing primarily by taking over smaller companies, buying assets from private capital firms and so on, rather than from, throughput gains. In other words, the producers that we call this called the discipline of shale. I mean, they're also producing to price. I mean, they're not going to just produce for the sake of increasing output as shale companies did back in 2013, 2014.
Well, you also didn't have electricity demand like you said earlier, but
Yeah,
now it looks like we have a clear case for electricity demand. On top of that, the US is now either number 1 or number 2 for liquefied natural gas exports, and probably over the next 10 years we're going to be clear number 1 with all these additional facilities that are going to be built and coming online.
yeah. It's so they are actually producing to real time demand, I guess would be my main point with the gas companies, just as the electricity companies are doing. They're not just, building something and saying, someday this will be used. I mean, they're getting things built as fast as they can. And, it's a tremendous opportunity. It probably should be a much larger one, and it should be, nationwide. But I think there's plenty of opportunity from the companies that are doing things in parts of the country that, haven't, been talking about shutting down natural gas distribution or forbidding people from using natural gas heating or trying to do away with gas stoves. It's a big part of the country that is in that camp, but there's also a large part of the country that is not. And these gas companies, again, have a real opportunity, and it's pretty low risk because, again, they're not just producing and building things for the sake of expected future revenue. They're building because the demand is there right in front of their face. Liquefied natural gas exports. I mean, that's, I think, a very long term and locked in opportunity. There's a large amount of capacity that's going to come online in the next 3 or 4 years, just from things that were permitted before they had the permitting freeze, and now that they've done away with the permitting freeze, there's more. There are more facilities being built. Energy Transfer, incidentally, has one. It's Lake Charles facility in Louisiana. So that's one that they're now in the process of contracting and expect a final investment decision by sometime this year. But in the meantime, the data centers are driving quite a bit of demand as well. People ask, like, what kind of companies do I want to look for? When I'm looking at midstream, and my view for really since the end of the last upcycle, I think what we've seen is more and more market power consolidating. In Canada, there's only three basic midstream companies of import that have large enough asset bases where they really kind of matter. So, but in the United States, there have been as many as 100
What are
at
the other
various.
companies in Canada besides Enbridge? Because Enbridge is a large one.
So yeah, Enbridge, you've got also TC Energy, and then another company called Pembina Pipeline. They're the number three. They started out as an income trust about 20 years ago, but have just been very smart about where they've expanded. They basically initially were just serving pipeline infrastructure to oil sands companies at that point in Canada. Now they have quite a bit of other infrastructure. They're actually building an LNG facility on Canada's west coast, where to export LNG, but also NGLs, natural gas liquids, things like propane and so on, to Asia. That particular the Pacific coast of Canada has always been pretty ripe for doing that. They've just had a mountain of regulation to overcome to get anything built. So
Yeah,
now
isn't Japan
yeah.
also Japan also just announced a deal, right, with the US for a $44 billion facility for liquefied natural gas export facility in Alaska. So there is capital going into what Canada around there and then also in Alaska.
Yeah, absolutely. And these other countries are they need it too. It is again more expensive than just piping gas from Appalachia to the Carolinas, Virginia, and the Northeast. I mean that's the cheapest among the cheapest gas in the world. Canada also has very cheap gas in the Pacific Northwest, smaller population centers than the U.S. market. So it's in good it's well positioned for export. And the first LNG export facility there is it's a Shell facility. It's called LNG Canada, and they're going to be making first shipments starting at long last starting this year. So there again, there's a lot going on. They're
But
it's a shorter shipping channel, I guess, from Alaska and Canada than it is from the Gulf. So going when you're talking about Asia and Japan
but you think the best profit potential then is the companies that own the pipeline, say from the cheapest natural gas one in the Permian Basin, so Texas,
yeah.
Oklahoma, New Mexico, and they're moving that gas either to a new data center in Texas or to a liquefied natural gas export facility in Texas or Louisiana?
Yeah, I think that's the surest thing looking at you right now regarding gas and again they also have as you point as we pointed out the LNG export angle and the reshoring angle. There's another Kinder Morgan, big pipeline company, just recently announced a major supply deal with Entergy, which is a big electric utility, and they're going to be bringing gas to the industrial corridor in the Port Arthur area, uh, which has been the beneficiary of a lot of reshoring of manufacturing coming back to the U.S. To solidify supply chains. The pandemic was a massive supply chain disconnect, so that's part of it. They've also been incentivized to bring in manufacturing, and then also, by tax credits, but then also, to get inside the tariff walls. So reshoring is another big deal, and it's a lot of it's happening I think most of it's happening in the southeast and in Texas. So,
Now
uh,
those pipelines from the Permian Basin with the cheap natural gas, which companies own them? Is it Energy Transfer Partners? Is it One Oak? I know there was a really large pipeline project called the Matterhorn project. Are there other projects planned?
there's a lot. Yeah, I mean, there are a number of projects planned. The pace to date has been, for those big pipelines, has been fairly cautious because, again, they want to have orders. But Kinder Morgan just announced this year is massively ramping up their capital spending, and they increased they had backlog projects increased from like 5 billion to 8 billion just in the fourth quarter alone. So they're seeing a lot of new business. So Kinder Morgan would be one of them. It's also the largest gas shipping company in the country. Energy Transfer, we mentioned, is another one involved in that business. Williams Companies is another. Um, so there are a lot of companies that are vying for that business. One Oak, as you mentioned, by merging with a company called Magellan Midstream about a year and a half ago, they have uh, a lot of a lot of potential routes, and they're also involved in. They also have oil pipelines too. So
And
that's another.
I think Plains All American, I think even Enbridge has talked about building a pipeline around there too.
And TC Energy, as we've mentioned, which is the former TransCanada, they're now mostly they're now pretty much a gas company. They spun out their liquids pipelines, which was a company called which was the Keystone Pipeline, and they spun that out in a company called Southbow, which I think is also kind of interesting. That spin out happened late last year. South Bow or South Bow, not sure how to pronounce it. They own the Keystone Pipeline system, and if we ever do get a better U.S. Canada government rapport, which could happen, I think there are elections coming up in Canada, and the Tories or the Conservatives are running ahead. Their advantage has narrowed somewhat. That's from for nationalism, I guess. Some of the comments from our president. Um, but I think there is a pretty good chance that the Conservatives do win there. That's traditionally very good for Canadian energy companies, and again, that was a getting the northern leg of the Keystone pipeline built. That was a major goal of the energy policy goal of the first Trump administration. Would it be again? Perhaps so, under a different government in Ottawa. So that's another
Do
one
you
to
mean
take a look
finishing the
at.
Keystone? Sorry to interrupt you. Do you mean the full
Yeah.
Keystone pipeline? Because you said that the northernmost part is done. You mean getting the whole thing finished?
Yeah, the southern part is now. I mean, they got that done, and that carries oil from the Cushing WTI Cushing hub in Oklahoma to the Gulf Coast. So that's very much in service, fully contracted, very used and useful. What didn't get built was the leg that was going to cross the border, and that was rejected, I guess, in um, 2012 perhaps. But it's and then TC Energy, when it still owned that system before it spun out Southbow, um, they uh, they put the project on hold just because of the Biden administration canceled its cross-border permit. So that's another pipeline name that people might be interested in. It's not so much gas, and that's what we've been talking about here. It's pretty much an oil pipeline company, but I think it is um, an interesting one. It yields around 8% too. So that's one we've been telling people about. The gas pipelines, though, TC Energy, the remainder of that company, very big player. And like I said earlier in the podcast, they're the owner of the Columbia Gas System, which serves the Virginia corridor, Northern Virginia corridor of data centers. And there are apparently a number of arrangements being negotiated there. So that could be a big lift for their business as well. Um, uh, anyway, I guess the best of the biggest is kind of the theme that I'm throwing at you here. In order to build anything like a pipeline, a system to make an acquisition, you've got to be a fairly large company. And really, the market power has been moving towards these companies through the bear market in the previous decade in energy, when prices were kind of ratcheting downward over time and companies were increasingly stressed. Uh, they
Especially
started
natural
taking.
gas. Yeah. I mean, natural gas
Yeah.
prices didn't rally for many, many years because there was so much byproduct from the shale oil production.
Yeah, and oil itself was actually priced had a negative price at Cushing in April of 2000 of 2020. Sorry, so right in the middle of the pandemic. So um, pretty much pure carnage in the midstream sector, and out of like 100 different names. If you go back to say 2014, when so many companies were spinning out midstream companies, there are all these IPOs, um, which we were incidentally pretty bearish on in Energy and Income Advisor at the time. Uh, but from that, we've now consolidated, and I would say we're down to right now a dozen at the outside midstream companies that really matter in North America, and that those numbers are always in danger of shrinking. I think we haven't seen the last big merger in that space, and I think if the justice and the the regulatory apparatus does become as favorable as people think it will to the energy sector, I think we will see some of those big deals. So we have seen some pretty nice gains in a lot of these midstream companies over the last 4 or 5 years or so. But I think we're still early innings and we're Elliot and I are calling this the year of natural gas. We think this will be a year where people will really start looking at the major players. And again, we don't need heroics for these companies to make a lot of money over the next 4 or 5 years. We don't need Massachusetts to decide it wants a gas pipeline. Could happen. I think if you do get an investor, a developer that goes in there, they're going to have a very nice deal. They're going to demand a really nice deal to commit that kind of money. But again, they don't have to go there. That doesn't have to happen. Um, we don't have to go 100% natural gas in new power generation development for gas companies to really make a lot of money here. So
Let
that
me
would,
ask you if these natural gas pipeline companies are and the electrical utility companies are they consistently growing their dividends or are they kind of keeping their dividends in a range for now?
I mean, the companies that most of the companies I recommend to people, they are raising dividends on a regular basis. It is fair to say that with this kind of restraint for longer from the Federal Reserve, uh, keeping interest rates at higher for longer levels, borrowing costs have, of course, also kind of spiked up in the early days of the Trump administration when people were talking more about tariffs and things that uh, people were worried about causing inflation. Um, companies have reacted to this by basically slowing the rate of dividend growth, and not just in energy companies either. In fact, energy companies probably have a clearer road to greater profitability, but uh, than other industries. But there is recognition that the cost of capital is likely to remain higher, uh, higher than it might have been over the next year or so. And again, that's where companies have reacted by saying, well, we'll just pay out less, we'll hold in more cash, and that way we can self fund more of uh, our capital projects. The midstream companies were pretty much cut out of raising capital for a good long time. I mean, really starting in 2015, there was a crash in the market, and ever since they've had a very hard time raising equity at anything resembling an economic price that they could make money with that kind of funding with any kind of project they could build. That's kind of been out the window. They also stopped issuing debt for a long time because credit ratings were under pressure, and any kind of big issuance would have caused that. So we actually saw a number of companies, and we mentioned Plains a little bit early on, Energy Transfer. These companies actually cut their dividends pretty severely in the previous decade so they could be self-funding. Kinder Morgan also, so they could self-fund their projects. In other words, by holding in that, not paying it out in dividends, holding in that cash, they could devote that to capital spending and therefore not have to access capital markets at all. It was kind of a go to the ground strategy by these companies, and they're not doing it anymore. But I think people should understand that that's really where this industry is coming from. I mean,
So you would describe that
yeah,
as what bear market survival mode, that they focused on getting leaner and meaner
yeah.
instead of spending more, they focused on being more efficient and cutting expenses.
And that's absolutely, that's still the ethos, I think, with a lot of the companies. That's why the producers, will, when they get a windfall in terms of price, like they did in, 2022, they devoted it to stock buybacks, to paying off more debt, to paying special dividends. And that's still kind of there's 10 companies we cover that are producers of oil and gas, and they pay a substantial part of they pay their dividends divided into two pieces. They have a base dividend, and then they have a variable dividend. And the variable dividend is what they use to reward shareholders when energy prices go up. Energy prices aren't necessarily that strong right now. Gas has been stronger, but oil has been down around $70 a barrel. Gas has still been holding under $4 per million BTU, and so these are levels. They're not the kind of levels that we saw back in 2022. So companies are continue to play things somewhat conservative. So that's kind of a long-winded answer, but yeah, they're still raising dividends, but they're also doing so at a more modest pace. Uh, Again, in order in observance of this high cost of capital, and the midstream companies really never stopped doing that. The utilities have, they're still expecting pretty robust uh, you know, growth rates for earnings. They're spending a lot more, but at the same time, you see a lot of companies not matching that growth with dividends. So they might be growing their earnings 6 to 8% a year or something like that, but they'll only be growing the dividend, 3 to 4%.
So that's being
Um,
cautious, and so
yeah,
they're not paying out as much as income investors would want. But it sounds to me, Roger, like a lot of these companies, whether it's electrical utility companies in areas like Georgia, Texas, Northern Virginia, and then the natural gas pipeline companies, they have more growth opportunities. But that also means that they have to spend more to get the future cash flow. So they have to invest in the growth capital expenditure first and build the pipelines or build a new
right.
natural gas turbine facility or something like that, which is what we're seeing that now with Chevron. I think Chevron just announced the deal too with General Electric with the natural gas turbine companies, like a joint venture deal where Chevron's going to be supplying the natural gas, helping build the pipeline, and then General Electric is going to be building the natural gas turbines.
Yeah. So, again, that's kind of a joint venture. Everybody gets a piece of the action, and without taking all the investment risk. And at a time when interest rates are volatile, and much higher than they were a few years ago. I mean, there's still uh, companies don't want to borrow unless they have to refinance. There's a lot of refinancing going on as well. But generally speaking, it's the time when people are being cautious with capital, and not just in energy, but also, real estate. If you look at real estate investment trusts, if you look at almost anything, there's a, a, a not. I mean, there's a reluctance to like not spend anything on, not to invest anything, but there is certainly an incentive to, if you're going to spend something, to make sure that you got it covered, and you're not going to be hanging out there with some sort of extremely expensive credit line that turns the project into a money loser. That's something people are very much aware of and as a risk, and are doing things to prevent.
Now, the capital expenditure that the big technology companies are spending, and I have the base case, like I said, around $300 billion. I mean, I've seen estimates that are higher than that. That's not even counting the Stargate AI project that was announced with Donald Trump and Larry Ellison from Oracle and Sam Altman, the head of OpenAI, which runs ChatGPT. And then that doesn't count any data centers that the European Union is going to be building. I think they just announced the 200 billion. Their plans are to spend around 200 billion over the next 5 years on data centers, and no one knows the real number that China wants to build. So, my
Right.
question then is about how much capital expenditure out of that money for big tech are the natural gas pipelines, are the electrical utilities, are they going to count on big tech giving them some money for like a joint venture deal to build this, or are these other companies going to have to come up with the capital expenditures, billions of dollars on their own?
I think what they're going to look for is contracts, and an assurance that they, at the end of the day, get paid. And that could be direct contracts um, with gas pipeline companies. It could be contracts with electricity producers that are in turn contracted to gas pipeline companies. But I think that's going to be the main uh, the the main kind of model that they're or the condition that they're going to be looking for. Um, is and basically just again secure supply, secure contracts, and that's more or less how that business has been run again since well really since the bear market in energy in the previous decade kicked in and they kind of went to ground. There was a period there where um, it was kind of a build it and they will come mentality, and people lost a lot of money doing that. So um, yeah, I think contracts. I in terms of a technology company funding construction of a pipeline. I mean, never say never, right? I mean, that could certainly happen. I think they're more likely to finance a nuclear plant because of the net zero thing. But um,
Well,
necessity is the mother of invention, and if you have the money, you're gonna and you need there's a service you need. They definitely have the money. There's definitely a service they need. I think if there's shortfalls in any way, you could see some of these more creatively structured deals.
yeah, to add to your point there, Elon Musk and XAI, they had to do that for natural gas pipelines for the Colossus data center in Tennessee there. So I don't think he had access to nuclear power plants nearby. So he went and he negotiated the natural gas pipelines and he got them built way faster than normal. I think they built the first scaling of the Colossus data center in around 120 days, which has around 100,000 GPUs. And they just made an announcement today, well, in the last 24 hours. So, like Monday night on February 17th, because I have the live stream show, I'm going to go watch it. That was recording. They've just scaled that data center up again to 200,000 GPU units at a single data center. It's just astronomically large. The rest of the industry is catching up. I mean, that's going to use an unfathomable, yeah, I just bumbled that, an
Yeah,
unfathomable amount of energy, what, for not only powering the electricity for all these GPU units, the hyperscaling server racks there, but also like the cooling systems.
yeah, absolutely, absolutely. You got to have it. You got to have all of it. With that, and yeah, I mean, what you're saying. I mean, they're just the scale of some of these things that we're talking about is just kind of off the chart. It's not really the kind of thing that we've seen.
Well, the old data centers, the ones that we use now to like record this podcast, which are for like Netflix for streaming or voice over internet, any type of normal internet usage or Netflix or streaming or YouTube or Twitch, that's an enormous energy hog. But we're talking like an order of magnitude, Roger, for these new data centers. I mean, like they're used to the engineers in the industry used to think that only 30,000 GPU chips were the maximum for a data center, and XAI just built 100,000 with the Colossus, and now here we are up to 200,000. I mean, that's way more electricity usage.
Yep, and it's going to have to come from somewhere, and I think it's going to have to come from a lot of different places.
All of the above, as Trump's new energy secretary has said in prior, before he was picked by Trump to be the energy secretary. I mean, he was talking about investing in all of the above for all forms of energy, that he doesn't want to block anything.
Yeah, I think that's smart. I mean, I think the federal government, there are things it can do, to help this investment boom go forward. There are definitely things it can do though to slow things down. And we've seen that at various times. It's not, yeah, so not all powerful, but uh, certainly, it's. I think they're on board with what we're seeing now, and that's a um, perhaps a change from what we had before, which was a lot of conditionals. Even solar panels and solar farms and wind facilities and battery. There was a lot of conditions placed on projects. Local content, and so on. Labor uh, concerns and so on. So um, as much as that, some might view that as worthy. I mean, the more you remove of those types of things, the easier it is for the investment to flow and to get things built. So um, I do think that will that seems to be where we're heading the next few years here.
Well, unfortunately, I think a lot of these large solar farms or solar power plants have been a huge disappointment, because I don't know if you saw the large Obama one. It was projected to last 30 years near the Mojave Desert, and they're scuttling it after about 11 years. So they said that the plant doesn't work. A lot of the equipment's malfunctioning. The solar panels all need to be replaced. They spent over $10 billion on it. It's supposed to last 30 years. It lasted 11. So I mean, like, it's been a huge disappointment so far.
Yeah, I think you know uh, that's I think one reason why maybe you want private enterprise. And investor-owned utilities have done a really good job building because they're and so is the private sector because there's definite accountability. But yeah, every time I hear about this or that government project, it kind of sends chills down your spine with perhaps some of the decisions made and so on.
Well, also like the quality of the solar panels. I mean, what was good 10 years ago is obsolete now. So, I mean, like those solar
Yeah.
panels were probably installed, what, 10, 15 years ago, something like that. They're not going to be as good anymore. I mean, we're seeing improvements in the lab, but these things like have issues. Honestly, if I'm running a large technology company, I would supplement with solar panels and I would keep upgrading to the new one. So I'd put the solar panels on my data centers, either on top or around, but that would not be my base load. I would make sure I got either nuclear power or make the natural gas pipelines, or both. I would want both actually, and then solar as a supplement.
Yeah. Well, they're yeah. I mean, I agree with you. I think there are definitely challenges with every um, uh, power source, and the idea that one of them can solve everybody's problems is unfortunately one that's kind of ingrained in the public, you know, perception, um, and on all sides, right? But the way that things work is, you have a diversified power stack, and that's what utilities have known that for years, but and have practiced that for years. But it's utilities and energy. Um, it's kind of an esoteric. Historically, it's been something of an esoteric subject, and I think now it's perhaps a little more politicized, unfortunately. But
Well, also like solar panels and the wind turbines are not exactly environmentally friendly. So like a lot of the people that say how good they are, I mean, look at all the rare earth mining and all the chemicals and toxic material and radioactive material that has to be separated out and use tons of like toxic chemicals in the refining process. So like China's their air, water, and soil around a rare earth mine is destroyed. So the environmentalists can point to the solar panels and the wind turbines.
Yeah. Well, again, there's a lot of there are a lot of
There's problems with all forms of energy,
problems
Roger.
with
I mean,
all forms of
yeah,
it.
you brought this up, but
Yeah.
it's just like I hear this all the time from even the data center people, the people that are building these data centers. We have to use solar. We have to use solar. And I'm thinking to myself, like, solar has huge issues. The big technology companies know it's not reliable. They know they need natural gas or nuclear power as the main baseload reliable form of electricity. So yeah, I'm 100% in favor of putting solar panels either around the data center or on the roof or something like that. But if you're spending billions of dollars to build each one of these data centers, I mean, if you're not going to want something as unreliable solar panels to be the main, uh,
To be your only source. Yeah, I mean,
yeah.
any more than you can run the power grid off of solar only.
Well, if you're
But yeah,
Amazon, if you're a cloud computing company like Amazon or Microsoft, and some of your data centers go down, I mean, like you're going to have customers threatening you or suing you. It's a mess if you only put in solar panels and those cloud computing data centers, which also are going to be doing artificial intelligence, those things go down. You're looking at lawsuits for businesses, their website going down or data being lost, those types of things.
yeah, it's kind of hard to envision, any serious company, actually, anybody actually building a project, you know, falling into that. But it's certainly possible. Uh, Unfortunately,
Well,
I
I
guess.
think the data center companies that are trying
Yeah.
building out these things, they're saying that they want to just do solar, but like the capital that's being allocated by the technology companies is saying otherwise. The electrical utility companies too.
Yeah.
Well,
Well, it'll be interesting to see, the next time we talk about, you know, what, what's, what's happened. Um, how,
I think we're
yeah.
looking at a very long-term bull market for natural gas demand with both the data centers here in the US and liquefied natural gas exports. I mean, that's a lot of opportunity.
Yeah. And I think, again, I don't think you really don't have to make heroic assumptions, to like a lot of these stocks. They've been positioning themselves for this for, uh, the last 10 years. So,
Oh, you mean during the bear market? Because like
yeah.
it
Oh, yeah. During the bear market, they've been, you know, taking more, I mean, there's been quite a bit of acquisitions and so on. So we're really, this sector has really consolidated a lot. And, the leading names that we've talked about here, I think they're much stronger companies than they were 10 years ago.
Oh yeah, I remember the bear market and Kinder Morgan changing from what a MLP to a C corp and how they screwed that up and the share price dropped what almost 40% in a few months.
Yeah. Yeah. So again, a lot of, they, basically I think had too much debt at that particular time. And, the business contracted and, yeah, there's still people that talk about getting Kindered, although that stock has done, really well, in the last, 4 or 5 years. Fine,
Well,
particularly the last year or so, it's more or less kind of broken out.
yeah, I would much rather own a natural gas pipeline company, a utility company that could potentially grow its dividends than, say, a US Treasury yield on a long term bond, say 10-year, 20-year, 30-year US Treasury, where there is no dividend growth. Because I think there's more of an inflation hedge protection. Those industries that you talked about for the last 45, 50 minutes, there's growth opportunities, there's potential to grow dividends there. I think these are better and safer than bond alternatives with the potential for dividend growth and yield.
Yeah, I would totally agree with that. I think, yeah, you've, and that's always, I think that's always, brings even larger point. The fact that, there have been so many strategies that have been sold to people, based on the idea of you have to own X amount of bonds and so on. And you just, yeah, you really don't. I think you are much better off just buying a portfolio of stocks and getting your yield that way. And
Well,
yeah, there were some.
these are safe businesses with cash flow, but now, as we talked about in this interview and our last interview a few months ago, there's actually growth opportunities, and the growth opportunities means more investment and the potential to grow dividends and free cash flow in the future.
Yeah, absolutely. And really big dividends now. So you're getting uh, quite a bit for your money now. I mean, 7% yields. That's uh, what, 3 or 4 points more than a bond that doesn't grow its dividend and is exposed to uh, some of the turmoil that we've seen.
Well, yeah,
Uh,
the bond. I'm seeing people all the time asking me about like locking in a guaranteed yield in a long-term treasury, what, 10-year, 20-year, 30-year. And I'm like, I'd much rather own a utility company, electrical utility company, or a pipeline company that has a stable business, demand, potential growth opportunities where they can actually grow the dividend if there is more inflation to offset some of that inflation risk, because I just see so much risk right now in the government bond market, in US Treasuries and other G7 government bonds, Japan and other European Union like Germany and those types of countries. There's just so much risk there. I think it's safer for an electrical utility company or a pipeline company, in my opinion, at least.
yeah, I think so. I think you could also, yeah, exactly. Particularly those types of businesses. Um,
Well, I think we should wrap it up there, Roger.
okay.
It's a very interesting time here. I mean, the growth opportunities here, the capex pie here, it's going to get spent, and I think like the electrical utility companies, the pipeline companies, they're going to benefit heavily from this going forward, at least for the next couple of years. I know a lot of people are pushing back on this with like DeepSeek AI, and they're saying that the technology companies are going to slow down the spending. I don't really see any signs of that now because what they projected with the budget. Now, maybe they won't spend the amount of money that they're saying that they will for the Q4 earnings, because over the last couple weeks they've been saying what Amazon said 100 billion, Microsoft a couple months ago said 80 billion for this year, Google said about 75 billion. So maybe they don't spend that amount of money, but if they do, I mean, the companies that you talked about the last 45, 50 minutes, they're going to benefit, I think.
Yeah, I think, and again, I don't think they really have to. They don't have to spend as much as you know, as some of these projections. I mean, any um, and there are other drivers, as we pointed out. The reshoring and so on, and they're even for the whether you're talking about electricity or gas. I mean, they're uh, it's a. I think these are what we're seeing and what it's all happening in real time, and those are real time orders, real time capital spending, just that is based um, on those orders, and that's what drives growth. I don't think again that there are some stocks in the sector that have gotten a lot of attention. Constellation Energy being one. We talked about that one. As the leading nuclear generation company, but it's also up quite a bit. And there are a number of stocks that really aren't up that much. So um, it's still it may not be you may not be getting in this thing in the first inning or second inning, but it's certainly still pretty early on to take advantage here, and a lot of names that people aren't looking at, um, which we've talked about here.
Well, I want to thank you so much for your time today. If my listeners want to check out your newsletter, the Energy and Income Advisor, or the Utility Forecaster, how do they do so?
Well, you can go to you can go directly to the website, which is conradsutilityinvestor.com, or you can go to energyandincomeadvisor.com, and that's the website for that publication. You can also check me out on Substack, and I do a column there called Dividends with Roger Conrad. I don't know how many of you are familiar with that forum, but it is quite interesting. A lot of different authors are on there. It's a very vibrant platform. My Dividends with Roger Conrad is actually a free publication, so you'll get you sign up for it, you'll get a column every week. I do have a paid publication on there as well. So if you really like what I do, you can check it out. Check me out there as well. So that's three ways. And I look forward to speaking with some of the people who are listening in on this call.